What I'd like to do is touch on, just for a little bit of time, what kind of crashes we really have had in the U.S. and how that relates to what's going on today, because I'm not sure that the real story has gotten out about what we just went through. So first of all, there's three kinds of crashes. There's an economic crash, that is a crash that's precipitated by some economic event. And I would type that in 1929 and 1930, as well as 1987. 1929, for you historians, is the time where our wise leaders in Washington decided to pass the Smoot-Hawley Tariff Act, a 100% tax on imported goods. And in 1930, Herbert Hoover decided to raise the income tax rates from 25% to 63%, 68%. 1987 was that, no offense to you historians, Jim Baker's threatening the Germans with a dollar devaluation. It precipitated the European sale of securities during my first crash experience. We also had another type of market crash I call political or geopolitical crashes. World War II, this was the invasion of Germany to France. The October missile crisis. Now, I remember that well because I was a little kid and I had to duck under my desk every Wednesday morning when the sirens went off. I'm sure some of you remember that. And then, of course, 9/11. Now, the most unusual crash and the most difficult to explain to people are bank-induced panic crashes. We've only had one in the United States until a couple of years ago, and that one took place in 1907. You can read about it, and I would advise it, but very interestingly, we didn't have a Federal Reserve Bank back then. And the fellow who bailed out the banking system was J.P. Morgan. What few people know about that story is that it was a bank, a trust company actually, that went under. It was the Knickerbocker Trust Company, and it required that their loans get bailed out and capital be raised and all that stuff. But more importantly than that, the real story of that crash was a small brokerage firm in Tennessee, not that small, but relatively minor brokerage firm called Moore and Schley. And they were speculating on steel stocks, and they borrowed several tens of millions of dollars against their speculation. In today's terms, it was about $1 billion. And no one knew about it until J.P. Morgan got a knock on his door one morning. And there was the chief executive officer of Moore and Schley telling him they were about to file bankruptcy and go in hock. What Morgan knew that most didn't is that you can let a bank go under because there's a corresponding relationship between lender and creditor that can be tracked and traced very easily. You cannot let a brokerage firm go under. You can't let brokerage firms go under because they take their assets and lend them to other people, in this case stocks. And then that borrower of that security will take that asset and lend it to another broker, and then another broker, and then another broker. And so J.P. Morgan sent a special emissary down to Washington to see and seek Teddy Roosevelt's authorization to allow that company stock to be merged into the U.S. Steel Company, the stock that was leveraged by this Moore and Schley. I tell you this story because you need to know that the most important problem what we went through is that no one learned the lesson that J.P. Morgan knew in 1907. And our leaders in Washington let Lehman Brothers go under without protecting the counterparties. That is, without protecting the lenders and the creditors. It was all well and good and appropriate that the shareholders get wiped out at Lehman. And it was all well and good that the bondholders got wiped out at Lehman. What wasn't good was subjecting all the people who had transacted business through Lehman, who had nothing to do with the ownership of the company, to have them sit in limbo for basically 6 months before they figured out what their mistake was. So I bring that up because as we learn more about the situation, I think we need to reduce the level of fear and consternation about what really went on. And the likelihood now of any mistake of that nature happening again is very remote. In fact, if anything, as you can see from watching the Fed, they're going in the other direction, making sure it's never going to happen. So that's unlikely to occur. As a side note, the only other time that I had seen a similar bank-induced panic was in 1825 in England. So these are really rare events. So my comment to you would be, in following up with Arnie's observation, these kinds of crashes will happen from time to time for a variety of reasons, but when they do, they don't stay there very long.